time value of money has many applications, starting from bank loans, finishing with retirement plans and investments. A good example of time value of money application are annuities and perpetuities. In case of the annuity, we know that it is an investment or asset that pays a fixed sum each year for a specific number of years. In other words, annuity is a stream of cash flows at a regular intervals with a finished maturity. So maturity is finite in this case, and after end of the time frame, the cash flows are going to stop. In case of the perpetuity, it is a financial concept in which cash flow is theoretically received forever. Basically, it is a stream of cash payments that never ends. And these two are very interesting concepts. And as you move forward, you can choose for your cases and examples any kind of financial product that can bring and help us to understand better the time value of money concept. So here we will end with the present value and future value analysis and discounted cash flow analysis. And let's move forward. Despite of discounted cash flow analysis and time value of money concept, there are other financial decision making tools, techniques, and all these techniques related to time value of money concept. The article titled "The Theory and Practice of Finance, the Evidence from the Field," published by Graham and Harvey in top journal of Financial Economic, discusses the relevance of other valuation tools. And they conducted survey, and survey data shows that CFO use various investment evaluation tools such as net present value. As you can see here, 75% of CFOs, they highlighted that they use this tool. Internal rate of return, 76% of chief financial officers mentioned that they use this tool. And then afterwards, payback period and book rate of return and profitability index, they are also useful. And payback is 57% of CFOs use, book rate of return 20, and profitability index 12. So let's drill down and let's understand a little bit more about these other concepts, which is quite interesting. And let's start with net present value. Before we calculate the net present value, we must work out the present value. As I mentioned, these concepts are connected with time value of money concept. So how we do that? We do that by adding up all future cash flows, both positive and negative, and afterwards we discount them today. After we figure out the present value, we need to subtract the initial cost of capital, and that will take us to net present value. Net present value is a super important decision-making tool in finance, and as you saw, it is related to time value of money applications. And investors should, of course, go ahead and undertake projects with a positive net present value. And if net present value is negative, they should avoid these investments. This is very useful tool in investments and financial decision-making procedure. And basically, net present value is equal present value minus the initial required investment. Good example can be present value of $800,000 1 year from now at 12%. And if required investment is $700,000, if we plug in the numbers in the formula, we will receive the present value $714,286. And if we subtract from that present value the initial investment amount, so net present value is $14,286, which means there is a positive net present value. So go ahead and make the investment in this particular case. Obviously, we need to compare. We need to consider the opportunity cost that we learned in previous parts, but this is basically the concept. There are some rules for net present value calculation, and in the next couple of slides we're going to discuss those. Well, first one, for net present value calculation, only cash flow is relevant, and in calculation of cash flows, following corrections are necessary. First one, record capital expenditures when they happen. Second one, determine cash flow from income by adding back depreciation and subtracting capital expenditures. Then next one, take into consideration the working capital, which is a difference between company's short-term assets and liabilities. And later on, we need to do more corrections and make some more discounts, and it's a part of the net present value rules. Well, what else should be discounted or taken into consideration during NPV calculation? First, estimate cash flows on an additional operating cash flows basis. Second one, never confuse average with incremental payoffs. Third one, include the taxes in your calculations and include all incidental effects. Number fourth, forecast sales today and recognize after sales cash flows that will come later. Number fifth will be including potential benefits business misses out on when choosing an alternative over another. And we should forget the money that has already been spent and which cannot be received. Basically, forget sunk costs. And we need to be aware of the allocating ongoing business expenses that do not directly attribute to creating a product or service. Basically, we need to remember the salvage value, and we should remember the estimated book value of an asset after depreciation. Basically, again, as I said, the salvage value. In application of time value of money and in calculation of net present value, you should treat also inflation and interest rates consistently. In other words, be consistent how you handle inflation. Then use nominal interest rates to discount nominal cash flows, and use real interest rates to discount real cash flows. Basically, nominal interest rates refers to the interest rate before taking inflation into account, and a real interest rate is an interest rate that has been adjusted to remove the effect of inflation to reflect the real cost of funds. So you will get the same results whether you use nominal or real figure if you apply consistently. So this is about net present value. There are some rules, as I mentioned, to take into consideration to receive precise, more correct net present value figure. Next tool that many financial executives use is internal rate of return. As we mentioned, it is a powerful financial decision-making tool also. And one of the options we can use as a discount rate is the internal rate of return. And internal rate of return is discount rate at which NPV is equal to 0. And the rule of internal rate of return is invest in any projects or assets that will offer a rate of return that is higher than the opportunity cost of capital. Basically, the formula is this one, and you can find it in your handouts. And here you can see a small example of internal rate of return. Basically, you can purchase a turbo-powered machine, for example, and you can purchase this tool for $4,000. The investment will generate, for example, $2,000 and $4,000 in cash flows for 2 consecutive years, respectively. And what is the internal rate of return? Well, if we use the previous formula, you can come up with this equation. And very interesting tool for financial decision making. And in this particular chart, you can see the example of correlation between net present value, discount rate, and IRR. Many financial managers and investors, they use the gold standard discounted cash flow analysis and net present value. I'm just showing you some additional tools that are useful and you can consider to use in your future career. I hope you enjoyed this part of video, and we will start working on our case study. And you have a great day. Thank you. Enjoy the rest of your day. Bye.